Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are solving a past paper question. Now this is the March-June 2024 exam which is available on your ACCA practice platform. I'm going to be covering the question known as Gamgee company over here in this video. So this pertains to some calculations which are required in the first this part, and then as we move further, whatever requirements are there, they pertain to the discussion part. So let's get started with the numbers. Before I read the long scenario, I'm going to take a quick look at what the requirements are. So the very first requirement that I see is I have to calculate the above three ratios for the next year, assuming that the project is financed by the loan note issue. So basically this is a financing question. But with this itself, I get to know they have two options. Either they can go for loan notes issue, then they can raise money with that, or they can go for the rights issue of equity. So this is option number two that they have. So in the second part, you need to calculate the three ratios, assuming that they finance it using the rights issue. Then the third part wants you to use the calculations and then briefly comment on the results and recommend which source of finance should the board of directors be choosing. So in totality, you can see it is 8 marks of numerical requirement, then 3 marks is upon the recommendations. So you cannot simply leave your recommendations saying that the company should go for loan notes or the company should go for equity. You will have to specify the reasons why you are choosing whichever option you tell them to choose. So let's have a look at the scenario now. The scenario gives you that Gamgee company is a large listed company which has a diverse range of operations. Current information about the company is as follows. Current year operating profit forecast is given to you, debt is given. Equity, this is the number of issued shares that are given to us. Then you have the corporate tax rate. Current EPS has been given, interest cover has been given, PE ratio has been given, and the total gearing has been provided to us. Growth in profits has declined in recent years, and Gamgee company's large institutional shareholders are insisting that the board of directors should undertake an expansion plan. Now, the expansion plan is something like this, that the board of directors have developed a plan which involves a project requiring 360 millions of initial investment, earning an annual operating profit of $64.8 million. Now, how are they going to finance is that they do not have sufficient cash reserves to finance the project. Therefore, two financing options are under consideration. The first option is that they can go for an issue of 5% loan notes for 10 years, expected to trade at the nominal value. Option two is that a rights issue of equity at a 25% discount rate to the current market price. Whichever finance option is chosen, these are the assumptions. Finance will be raised and the investment will be undertaken in time for the project to be operational for the start of next year, and the PE ratio is going to remain unchanged. So now let's come back to our requirements. These are the three ratios that we can see on the screen that we have to calculate: interest cover, EPS, and the total gearing. They've also told you how they want the total gearing to be calculated. You need to take debt, and this should be divided by debt plus the equity using the market values. So whatever equity numbers that we will be taking, that will be based on the market value. So now let's start off with calculating the first part where we need to see the loan note option. So here we will start off with our answer. This is part A, where loan note option is chosen. Okay, so now we start off first. The very first ratio is the interest cover. So we need to calculate interest cover ratio. Now, what's the formula that we have learned? The formula says in your numerator, you're supposed to take the PBIT or your operating profit. I'll just write it. You need not write this in your actual exam. And that needs to be divided by the interest cost or the finance cost. So this is the formula that we have learned. And we will be putting this to use. So very first thing that I need is my PBIT. So for the calculation of my PBIT, I'm going to have a look at what is given to us in the question itself. So we have the current year's operating profit. This is forecast at 177. Now, if we are calculating these ratios for the next year, see, the question says the three ratios for the next year. So if we want to calculate these ratios for the next year, we are going to assume, like the assumptions are telling us that it is going to start from the next year. So in the next year, I'm not only going to have this much profit of 177, I'll also have the additional profit that this project is giving me. So here you can see the board of directors have developed a project, and this the earning is going to be annual operating profit of 64.8. So I'm going to take 177 and add 64.8 to it. So this is going to be my PBIT in the next year. Then if I talk about my finance charges or my interest costs basically, so this is going to be what I was paying earlier. Earlier, I had $450 million of debt, and on this debt, I was paying 6% interest. So firstly, I will have this liability, this interest I have to pay. And then if you are going ahead with the loan notes option, that means you're going with option one, where on the initial investment of 360 million, you will be paying a 5% interest on your loan notes. So your interest cost will now increase. You have taken 360 million as the loan notes issue. So this needs to be multiplied by 5%. So with this, you're going to get 45 million as your interest or the finance charges. Now you can find out the interest cover ratio. Interest cover ratio is going to be PBIT divided by 45, and your answer is always given in times. So it is going to be 5.4 times roughly. Now let's move on to the second ratio that they want to calculate. This is EPS ratio. So we will write EPS. EPS formula that we have learned is we need to take up the earnings after tax, and that needs to be divided by the number of shares. So let's first talk about how much will be the earnings that are going to be left for the shareholders. So like we have established, this is going to be our PBIT. From this, we are going to have to subtract the tax amount. So if my earnings are 241.8, from this I'm going to pay an interest of 45 million. Now on this amount, this is my profit after interest. So this is basically my PBT. Now on this PBT, this is profit before tax. I need to charge tax also. So let's see, the tax rate was also given to us. It is at 20%. So I will be subtracting 20%. So 1 minus 20%. So this is going to be the amount of money, amount of earnings that I'm going to be left with after paying finance charges, after paying taxes. And then the number of shares are also given. Number of shares that we have is 800 million. So my EPS answer is earnings is this much, shares are these many. So it is roughly 0.20. Now coming to the next ratio which they want us to calculate, and this is the total gearing ratio. Total gearing, where they want the debt divided by debt plus market value of equity. So let's first find out the share price. To find out the market value, so it is given that the PE ratio of the company is 8. That means price upon earnings gives you 8. So if you want to find out the price, it will be 8, the ratio multiplied by the earnings. So the ratio is 8, and if you multiply that by the earnings we have already calculated as 0.2. So you're going to get 1.57 over here. With this, you will find out the equity value. Equity market value. So if this is the value per share, you have 800 million shares in issue. You have 800 million shares in issue. So you're roughly going to have this much amount of market value of the equity. Now, if you want to find out the debt market value, debt already, bank loan is not traded in the market. So that remains at 450. And whatever is given to you with respect to the plan, they say it's going to trade at the nominal value. So the nominal value, that means the money that you have issued, that is the initial investment, which is 360. So your total market value of debt is 810. So now how do you find out your gearing? Your gearing is going to be, numerator is debt. Debt needs to be divided by debt plus equity. So this is my market value of equity. So if I convert this to a percentage figure, this is roughly what I'm going to get. So this is my gearing percentage. Now moving towards the part 2. Part 2 is wanting us to calculate the same ratios but assuming that the second option was chosen. So here we talk about rights issue, rights issue, right? So here the very first ratio that we start off with is going to be the interest cover. Interest cover. The formula we've already written above. This is nothing but your earnings divided by your uh, your interest cover is going to be, yes, your earnings, which is your PBIT, divided by the finance cost. So if you look at the rights issue, your earnings are going to be what you calculated above, 241.8. This is going to remain the same. What is going to change from the previous question is going to be the finance cost. So your finance cost is going to be in this case, because there is no other money that you are taking. The money comes in through equity. So your finance cost remains at 6% of 450. So 27 million is what your finance cost is going to look like. So now your interest cover ratio is going to be earnings divided by the cost. So it's going to be roughly 9 times. All right, so this is our first ratio. Moving to the second one, which was EPS. So how do you calculate EPS? It's going to be earnings. So the earnings which are going to be left after the tax. If this is the amount of money that I'm making, 241.8, from this I need to subtract my interest cost, which is 27. And now on this amount, I will be paying taxes. Taxes are 20%, so 1 minus 20%. So this is what I'm going to be left with. It's going to be 171.8. Now, if I talk about my current share price, so my current share price is going to be 8, which is the PE ratio, multiplied by now my 0.15, because that is the current EPS. So into 0.15 gives me 1.2. Now, how much am I issuing my rights at? Rights issue price. Rights issue price, like it was written, it's going to be at a 25% discount. So if the present price is 1.2, I'm going to give a 25% discount into 1 minus 25%. So you're going to get 0.9 over here. Now, how many number of shares are you issuing? Number of shares. So 0.9, if this is the value and the money that you want to raise is 360, so that means you're going to need to issue 400 million shares. So now your EPS is going to be the earnings, which is this amount, divided by the new number of shares. You earlier had 800, now you have issued 400 more. So now your EPS is going to look like 0.14. Now let's talk about the gearing ratio. The gearing is going to be, firstly, let's find out how much is your new share price going to be. New share price is going to be, because the PE ratio remains same, so 8 multiplied by the new EPS. So this is going to be 1.15 roughly. Then you're going to take the equity market value. Again, this is the market price per share. This needs to be multiplied with, earlier you had 400, earlier you had 800, you issued 400 more. So this is the market value of your equity. Then the market value of debt, because bank loans are not traded in the market, it remains the same at 450. So now your gearing is going to be debt divided by debt plus equity. So this is what we have. So roughly it's going to be around 25%. Now let's talk about the comment. With this, we are done with the first and second part. Now in the third part, we need to use the calculations and briefly comment on the results and recommend which option should be chosen. So firstly, talking about our comment, we will write over here that the loan note option, if you see, it increases the financial risk. So the gearing also increases. If you have a look over here in the first option, the gearing that we arrive at is 39%. And presently, your gearing is at 32%. So that means it will make the company more financially risky. And if you also see the interest cover is presently at 6.6. And how much does it come down to? If you have a look in this option, it comes down to 5.37 times. So if you go for the first option, the interest cover also gets reduced. Now, this increase in financial risk that you are getting, this is definitely, significant, and it will be something which shareholders will not really like. Now, if you talk about the industry averages, that is something which will definitely be useful because you can compare it with that. But if you talk about the diverse operational base that Gamgee company has, it can be problematic to find someone who actually does a business like them because it's written that they have a diverse range of operations in the very first line. Then, if you talk about the positive side of the first option, you can say that the EPS is going to definitely increase under the loan note option, which is going to give you an increase in the wealth of the shareholders. If you consider the rights option, the EPS is actually falling, right? Right now it is at 0.15. If you go ahead with the rights option, it's actually going to fall to 0.14. So, uh, if you go ahead with the loan note option, shareholders are going to be happy with this. So when you give a recommendation, you have to be diplomatic, right? So you can say how both of the options are good, and whatever the directors choose, that is something which can be taken up depending upon what the shareholders like. Now, moving ahead to the next requirement, here we have to discuss the problems associated with high levels of financial gearing. So, if any company has a lot of debt, then what are the problems that they can possibly face? So, this is rather a theoretical or discussion based question. Does not even involve linking to the scenario because the name of the company is not given in the requirement. So, here I am sure you would have studied this in your concepts. Firstly, you have the risk of bankruptcy risk. If the company is going to take too much of debt, then there is a risk that the company may not be able to pay the interest, maybe they are not able to repay the capital. So, if there is any time of financial difficulty, so this obligation can be too much to fulfill and it can cause the company to go bankrupt. Another thing that comes with it is the agency costs or the restrictive covenants. That means whenever banks are giving you too much loans, they can see that the company is dependent too much upon the loan, so they can put in some restrictions that you cannot pay this much dividend, you cannot add more debt, so it's going to make things difficult for the company. Next thing is the debt capacity. Every company cannot go on to take as much debt as they want to. So the debt capacity is definitely going to reduce because now you will have lesser assets which you can pledge as a collateral for taking debt. So if you go to high levels of debt, you will definitely be having lesser assets to use as a collateral, and you will reduce your ability to raise more debt. Coming to another point which you can mention here is increasing finance costs. So definitely, if you take too much of debt, the finance costs of the company increase, and the dividend payout policy will also be risky because a large chunk of the profits is going as a part of interest or the finance cost. So this will mean that if shareholders are taking so much of financial risk, they will also expect good returns. So not only will the company now have to pay the interest, but also offer good returns to the shareholders. Coming towards another point that you can write over here is tax exhaustion. What do you mean by tax exhaustion over here? Is that if you take too much of debt, that means your interest will probably exceed your taxable profits. So, in this case, it can possibly make you lose the benefit of tax deductibility of interest, which eventually defeats a very key benefit that the debt finance offers you. So these are a few points which could be covered over here. Moving ahead to the next requirement. So this is again pertaining to the scenario because you see the name of the company in the question. So, in a recent board meeting, the use of Islamic finance was mentioned as being another possible finance source, as the nature of the project and all Gamgee companies' activities are eligible under Islamic finance principles. The board wishes to consider the use of Islamic finance, but a condition that the board has agreed is that any Islamic finance arrangement should be similar to traditional debt, with no profit sharing or management involvement from the investor or the Islamic bank. So, if to discuss two sources of Islamic finance that could satisfy Gamgee company's needs for the project, taking into account the board's condition. So, the possible sources that you can talk about over here are Murabaha, which is trade credit, Murabaha. It is also trade credit. So what you do over here is that Islamic finance institution is going to purchase the assets for the project and then they are going to sell them to Gamgee company, where Islamic finance institution would be paid by Gamgee company in fixed installments. A 10-year term should be possible, and if the institute is not going to have any involvement, then the company is definitely going to approve this. Second, that you could write over here is an ijara. Ijara is similar to a lease. So any assets which they need for the project will be purchased by IFI, which is the Islamic Finance Institution. Then Gamgee company would be given the right to use that asset in return for the payments like a lease. So just like Murabaha, payments will be fixed and there is not going to be any management involvement. But there is a difference from the Murabaha. Here, the legal title will not be transferred to Gamgee companies until the end of the lease period. Another thing which they can do is a sukuk. Sukuk is similar to bonds. There is one more thing that they can do. Third is sukuk. Sukuk is similar to, like I was telling you, bonds. So under this arrangement, it will be linked to the underlying assets with the sukuk holders being the owner or partial owners in the assets, and they will be receiving a fixed income in return for that. So this is how you could talk about the requirement which has been asked. And with this question has come to an end. Do let me know in the comments down below if you want me to solve any other past paper questions. Thank you so much for watching.